back to the trading desk. We were talking a little bit about the fact that the market's gone nowhere in 10 years, and that it's our collective opinion that you need to do a little bit more than just buy an index fund and hope you make money. In periods like this, you need to educate yourself a little bit, and it's not difficult to find strategies that can help you generate better returns over these types of periods.
I agree with that, and I also think that when brokers and people talk diversifying, you also don't necessarily need to take all of your eggs, so to speak, today and put them into your different asset classes. There's probably still a timing component to enter into the asset classes that you may be considering, and just because it's April 1 and you need to put some money to work for your IRA doesn't mean you need to put it all into blue chip stocks or small cap stocks today.
It goes back to what Jesse always says: if it doesn't pencil out, if the investment doesn't make sense, whether it be from a PE ratio or for us technicians, if it doesn't make sense on the charts, the diversification attributes are lost.
There's a reason that buy low, sell high is one of the oldest adages in
rarely employed.
Yeah, but it is. But but I think you have to do things that way. I mean, there are going to be times when assets are attractive and other times when they're not attractive, and you just have to kind of keep your eyes open. One thing I look at in terms of trying to determine when things are attractive is sentiment. I think that's a big component of it. When people or when everybody wants to buy something and everybody's pouring money into an asset class, it's usually past the time when it was a good chance
and
to buy it.
one of the simple axioms I always find is the press is always, that meaning journalists, the press is always, when they're reporting it as a story, they're the last to know. And whether that's a positive or a negative headline, that's typically the time that you want to fade that momentum. I mean, when everybody's talking about, housing can't go down or stocks can't go down in the technology bubble, and your barber is giving you stock tips, and your barber, I had it happen, and we talked about it on the show, is giving you real estate tips.
Right.
Folks, that's sentiment, and that is really down to the core.
And so the way you use sentiment is if coming from a contrarian standpoint. When everybody's bullish, it's time to be conservative. When everybody's bearish and negative on an asset class,
then you've done your homework on the class.
Right, it's time to start taking a look at it. And one of those things you mentioned mentioned real estate, and the magazine cover indicator is one that's popular on Wall Street. And Time Magazine just nailed it. You nailed it.
Yeah, it was absolutely.
2 summers ago, they ran the
June.
cover.
It was like May or June of 2005.
The cover, make a fortune in housing or whatever it was. I don't remember the exact headline, but it literally called the top of the real estate market. And now we're seeing in The Economist, that the U.S. and the dollars,
The Economist nailed it spot on, and so did a German magazine. What I think is interesting right now, though, is about 6 months ago, everybody was wildly bullish before the banking crisis. And then, of course, everybody got super bearish in February and into March. But I think we're at a point right now where I think there's an argument to be made on either side. I think there's a lot of people pulling on the bull side, a lot of people pulling on the bears. I don't think it's as clear cut. I think it's
I think we have a string right now, and that string can go anyway.
Exactly. And I
sideways,
think
up, left,
positioning
right.
Wise, we're here to talk about, what are some things to consider. I think a defensive position right now, meaning a cash position, is perfectly legitimate.
Yeah.
I personally, I've been in cash since last summer again.
Absolutely.
And it was probably one of the best things I could have done.
When you don't have something to do, cash is the best alternative. Because it's, there are money market funds and stuff that are too risky.
You guys aren't necessarily saying stuff it in your mattress, though.
No.
I know.
And right now,
CDs at 5.25%. Right. That seems like the biggest investment nugget I can have.
Well, again, it comes back to it seems our central theme always seems to be risk. I mean, define your risk. How much are you willing to lose every time? And Dave, you wanted to talk about this. So, if you lose 10%, you've got to make back 11 just to get back to square.
Get back to break even. So, for those of you that are probably down 15 or 20% in your portfolio, guess what? You got a long road back just to get to break even.
Right.
So.
And you're fully invested.
Well, the best example of that is if you lose half your money, you have to double it to get back to even. You lose 50%, you got to make 100% to get back. So, taking on that risk makes a big difference. Another thing I'd just like to mention real quick is in stocks and in a lot of other asset classes, especially publicly traded, there are sentiment indicators where they take a regular poll of the market participants, and they'll tell you exactly how many bears there are versus how many bulls there are. And that's one great indicator you can use. Investors Intelligence is one, the American Association of Individual Investors, and they put it out as public information. So you can see when people are overly bullish or overly bearish and take advantage of that for time purposes.
Good.
So we need to take a break, but when we come back, we're going to answer one of your questions. You're watching The Trading Desk on COTV.